Hi, my name is Grace Cisna. I'm the CPA on staff with ProjectionHub, and today I wanted to take a little time to walk you through our brand new Growery template. When you download this template, you'll notice that like all of our ProjectionHub templates, there are input tabs shown in this light blue color here where you input data about your business. And then there are output tabs in this green color here. So once you fill out these light blue input tabs, the model will populate the financial statements, an income statement, a cash flow statement, and a balance sheet in annual formats as well as in monthly formats for you to use. So let's get started on the input assumptions tab, and I'll walk you through the different data that you need to input to build this model. So on all these light blue tabs, you will see that there are corresponding cells in this light blue color, and this is directing you to areas where you need to input or update data. There is example data already in the template when you download it. That's not necessarily an industry standard or even a recommendation from us. That's just base data so that there's something in there when you download it so you know what you're supposed to be putting in. So on this tab, you will enter your company name, your projection start month, accounts receivable terms. So if all of your customers pay for goods and services at the time that they receive them, then you should set it up like this with 100% and 0%. If you do offer credit to some of your customers, then you can change this percentage. So for example, if 80% of your customers pay at the time that they receive the goods and another 20% pay 30 days after, you can update this here, and that will add in an accounts receivable line item to your balance sheet. Next, you can enter your fixed assets. So some examples here, we have equipment, vehicles, greenhouses, generators, any farming equipment, etc. You can add that all here. You have up to 6 lines. So if you have more than 6 fixed assets, then you can create some broad categories to keep your balance sheet from getting too messy. So you can lump everything into sort of equipment or vehicles, etc. So you just enter the value, that's the purchase price of the equipment, its life expectancy, and its salvage costs. Both of those things help us calculate your depreciation expense. The model calculates all that for you and puts it on the income statement. And then you enter the purchase month of this fixed asset. Note that you see the 0 a couple times on the input assumptions tab, and that just means that you're purchasing this fixed asset before you begin operating. You'll see that as well for investments, if you may receive an investment before you begin operating. So that's what that month 0 means. So jumping down to investments, you have several lines here to enter investments. You can give them a name and a value, the value being the amount of cash that you receive, as well as the month that you receive that cash. The other way to finance your business would, of course, be loans. So if you have any loans starting the business, you can enter up to 4 here. You enter the loan amount, the number of monthly payments, the interest rates, as well as the month that your payments begin, and the model does the rest of it for you, calculating out that interest expense, calculating those monthly payment amounts as well. Note, the month the payments will begin is always the month after you receive the cash. So in this example, this $20,000 loan, the payments begin on month 1. That means that on the balance sheet, you'll see that cash coming in month 0. If payments begin on month 6, then we would see the cash coming out of the balance sheet in month 5. Jumping over to the input revenue and cost of sales, this is where the bulk of the model happens. Most of the work is on this tab. So we're going to help you set up your revenue model, predict out your revenue for every month, as well as predicting those your direct costs, your cost of sales. So right at the top here, you can pick up to 4 categories. So these are the broad categories that are going to show up on your income statement at the top. Just to show you here, they flow through right here to your income statement. So you can enter up to 4 categories. If you want to do less than 4, that's fine too. And then you can enter up to, I believe it's 10 products or product types. This could also be turns. So if you have the same product, but different harvests throughout the year, if you're using greenhouses, then you can enter the different turns here as well. So you can enter your products or turns and then pick one of these 4 categories. This drop-down list will be populated based on what you enter up here. And then you can enter your cost per plant. That's your seed cost or the cost of the clone, whatever it is for the plant itself. You enter the total plants that you're planting in this turn or for this product. The model will calculate the cost of plants for you. Then you're going to enter your total yield in pounds. and then your estimated selling price per pound. Just a note about this, you don't have to use pounds. That's just our suggestion. If you sell your product in some other form of measurement, maybe ounces, maybe barrels or bushels, per tomato, whatever it might be, depending on what you're growing, just make sure that you're using the same unit here, because what happens in column H is we multiply this, for example, this 1500 by 500. So if you were doing it in bushels, and you yielded 5 bushels and your selling price was whatever it may be, $500 per bushel, it's just going to do 500 times 5. So just make sure that your unit of measurement is the same for these two columns, and this will calculate correctly. And then you're also going to enter your estimated plant date and your estimated harvest date. Most important is getting these in the right month, because the model does not differentiate between days of the month. It gets as close as months here, but not any closer than that. So you enter your plant date here, and that helps us place the cost of the seed when that happens. And the harvest date really matters for the time that the cash is collected here. So note that this cash collected is being driven by the plant date to cash collected lead time. And that is a common time that we see for growery type of businesses. So you can enter in the number of weeks between plant and cash collected, and this cash collected will calculate for you. So once you've filled out all this, we're going to calculate first your revenue, and then we're going to look at the different growing expenses. So your revenue, there's a bit of detail that's hidden here that kind of calculates out each product. And then it is all summarized in the summary at the bottom. So looking at this turn 1, that's coming from category here, category 1. We just have one product right now in that category, and that's this first product here. And you can see right now we have $750,000 of revenue in month 7. And that is because for this first product, we have $750,000 of revenue, and it is being collected in month 7. You can see that the model then follows that same pattern each year. So we see in month 7 of year 2, or month 19, $772,000 of revenue. Well, that's that same $750,000, and it is multiplied by a 3% annual growth rate. So that's coming from up here. Your annual growth rate can represent a variety of different things. That can be price increases if you're increasing your price each year. That can be if you're selling more each year. So perhaps you're getting more efficient in your use of land space, and you're increasing what you're getting out of, you're increasing your yields essentially. So that could be another reason that you have an annual growth rate in revenue every year. So we see that here. Line 2, this is our turn 2 category. That's the only product we have in turn 2. We've got $225,000 in revenue, and the cash collected here is in month 10. So we can see there's that $225,000 in month 10, and it will happen again in the 10th month of the second year, increasing obviously at that same 3% again in the 10th month of the third year. So you can see that it follows that same pattern each year. So our total revenue here is summarized right here in this row. Okay, now let's take a look at growing expenses. So we've actually already identified one of our key growing expenses, and that is the cost of plants, or the cost of seed, the cost of clones, the cost of each individual plant. So that is broken down right here. We have product 1, and we have our cost right now. So this $8,000 for product 1 is cost per plant, $8. And 1,000 plants, so $8,000 here. And then it's actually placing it in the month based on this estimated plant date. So we're planting in April. You can see that $8,000 falls in April. For the second row here, we're planting in July. So the $8,000 falls in July there. For this last item here, we have $3 per plant and $1,500. So our total cost is $4,500. And this should fall in July. And there's our $4,500 in July. And again, this is going to repeat each year following here the annual cost of goods sold growth rate. So there's that $8,000 in year 1, turns into $8,240 in year 2, etc. All right, the other part of growing costs are our seasonal growing expenses. So we've got some examples here, some suggestions. And what you need to do is enter the type. You have plenty of lines to do that, the amount, so that's the cost. And then the month that that growing expense occurs each year. Note January is 1. So in this case, we've got lots of expenses in month 3, which is March of each year. We have some expenses in month 6, some in 9, and some in 10. So we can see lots of growing expenses in month 3, some in 6, some in 9, some in 10. And they will follow that same pattern each year, of course, increasing. So there's our March, month 6 in June, month 9, September, 10, October, of course, following our growth rate of 3% here. So those are your annual growing expenses. The last portion of cost of sales is your labor expense. So you can enter hourly labor amount, and that is a total hourly labor amount. You can also enter a manager amount per manager, and then set the number of managers down here. And then you would enter these by month of the year. So we can see that right now we only have labor costs and manager labor costs in March through October of each year. So you can see here, nothing in January, February. There's our March through October expenses, and then nothing for the 4 months until next March begins. And again, this grows at an annual rate, which you can set right here. Okay, then we have a summary of our 4 revenue categories, and then our 3 categories of cost of goods sold, which are total seed costs, seasonal growing expenses, and labor expenses. That is the bulk of the model right there. Another portion that we have is the input other expenses model. So this continues to follow our pattern of seasonality. This is a highly seasonal business, and so we've set up this model to really reflect that. So you can enter different expense items here. These are operating expenses, so not necessarily things, not growing expenses, not soils, not fertilizers, not water, but things. Here we have accounting, legal, miscellaneous equipment, property license, security, other startup expenses, all those items that are kind of separate from our growing expenses. So you have a couple ways that you could calculate your expenses. You can measure them fixed, so the same amount every month. You could also calculate them as a percentage of a certain type of revenue, so as a percentage of your total revenue or one of your 4 revenue categories. There aren't many examples I can think of where a growery would need to measure an expense as a percentage of revenue. For most businesses, we talk about credit card expenses as a percentage of revenue. So it could be that you're selling and your customers are using credit cards. If that is the case, then you could enter a credit card expense here, measure it as a percentage of total revenue, and you would enter something like 0.02 in the month January, and that would be 2% of your total revenues are fees that you're paying to Visa or MasterCard. So those processing fees to credit cards. So that would be an example of a percentage of revenue item. Most of your expenses I would think would be fixed, and we've got some examples here. For example, we have miscellaneous farm equipment. So in February through June of the first year, we're assuming that there's going to be about $300 per month of miscellaneous farm equipment, trowels, gloves, shovels, whatever it may be for your farm equipment. And then you've got some options here. So we ask you, does this expense reoccur each year? Well, yes, miscellaneous farm equipment, we're going to be farming every year. So we're going to say yes to that expense reoccurring each year. And if you do say yes, then you can enter an annual growth rate. So it's going to grow at 3% per year. Now, some expenses might not happen every year. So we've got this example here, the property license. Perhaps that's a 5-year or 10-year property license. So you don't want that showing up on your income statement every year. So you pay that for the first time in January, and then we put no here, and that doesn't reoccur each year. So I'll show you that that doesn't show up on the financial statements every year. It just shows up on the first year. Another example would be startup expenses. So whatever it takes, closing deals, signing contracts, all those sort of startup expenses won't occur every year. And so we put no for that. But the rest of them will reoccur each year. You also have an area here where you enter your effective income tax rate for each year. And I always recommend speaking with a local tax professional in your area to figure out the implications of local tax law for your business. Okay, so we've entered all we need to enter for the input tabs. So now we get to look at our output tabs and see the financial model that we've built. So we've got this at a glance tab. We've got some graphs and charts here that are ready to be clipped out and put into a pitch deck if you are needing a pitch deck for investment. So we've got some really high level summaries of the financial data, some key ratios, use of funds, so how you're spending your initial cash, and then your overall expenses for 5 years. Then we look at the income statement. So we've got our 4 sources of revenue, those 4 revenue categories from our input revenue and cost of sales tab. Those 3 cost of goods sold items from that tab as well, the seed, the growing expenses, labor expenses. We look at our gross margin, which is just total sales minus cost of goods sold. And then the percentage form is this gross margin divided by total sales. And then those operating expenses. So right away here, we can see those growth rates in our operating expenses. They're growing over time. We did have 2 operating expenses that weren't recurring every year, that property license and the other startup expenses. You can see those just happen in year 1, but not again. And all of these items here are coming from the input other expenses tab. Then we have 2 additional items, this loan interest expense, that is coming from the input assumptions tab, as well as depreciation and amortization, that's coming from the input assumptions tab. So loan interest expense is coming from your loans here, obviously. So the model is calculating your loan interest based on the loans that you enter. Depreciation and amortization is being calculated by the model based on your fixed assets. So your life expectancy in years and your salvage cost are helping us calculate your depreciation expense for you. The income tax, that is coming from the tax rates on the input other expenses tab. So then we get to our net income, which is just our total sales minus our cost of goods sold, minus our operating expenses, minus our income tax to get to net income. The cash flow summary is really similar. This is our annual summary. There are a couple items on the cash flow statement that don't show up on an income statement, and those are non-revenue or expense cash flow items. So cash from a new loan, we don't consider that revenue, but that is a source of cash. So we see that coming in. Cash from new investments, that's also coming from the input assumptions tab. Again, not revenue, but it is cash paid on loan principal. So when you're paying off those loans, we don't consider that an expense, or at least we don't consider all of it an expense. There is loan interest, that's the expense portion. But when you pay off any loan, there's the principal portion and the expense portion. So the principal portion ends up here on our cash flow statement, as well as cash paid for fixed assets goes here. Balance sheet summary, showing your assets, your liabilities, and your equity. Our balance sheets are always going to balance our ProjectionHub templates. That's one of the hardest parts of building a financial report on your own, is getting the balance sheet to balance. But these are going to balance for you, so you don't have to worry about it. So we've got those same 3 financial statements, but now in the monthly format, which obviously is a little more entertaining than the annual format, because we can see the monthly pattern of this highly seasonal business. So this is our income statement. We can see the revenue coming in from our different products, our turn 1, turn 2, our specialty, and other. And remember, this is a cash collected month here, so that's when we're bringing in revenue. We've got our growing expenses here. So the seed cost was happening. We had 2 different, we planted some in April and some in July. We had those growing expenses month 3, month 6, month 9, and 10. All those growing expenses are showing up here in their proper month. And then that labor expense all happening in the middle of the year, like we talked about. And you're going to see this same pattern down here in year 2, but obviously the expenses have all increased because of those annual growth rates, and the revenue has increased as well because of that annual growth rate. So we've got 1,004,000 in revenue versus 975. So it is increasing a little. And then we can see here all of our operating expenses are following the pattern that we established on the input other expenses tab. So for example, we had security just in months 7 through 11. We had product on hand. We can see that that is coming directly from this line 10 here. July through November of security costs. So that $5,000, and then we can see that same security costs again happening in July through November of the next year, but this time it's increased because of the annual growth rate. So we've got the month-to-month versions of the financial statements. So that is a brief overview of our Growery template. This will help you develop your financial projections for a Growery, whether you need them for an investor, for a bank, just for your own personal planning. Please reach out if you have any questions about this model. We are available at support@projectionhub.com. We help clients with these models on a regular basis. So if you have questions, please reach out. You'll often be speaking with me, the template creator, directly. And I'm always happy to answer questions. We can also modify this template for you. Maybe if it really works for your business, but you have an extra added revenue line, or we need to restructure it a little bit, we're always happy to do that. Or if you like the template, but you don't have time to fill it out on your own, please reach out. We're always happy to fill it out for you as well. So don't hesitate to reach out to us at support@projectionhub.com, and we hope this template is really helpful for you.